Please like, share, comment, and subscribe the channel. The monetary policy system of the Reserve Bank of India, RBI, plays a crucial role in maintaining economic stability by regulating money supply, controlling inflation, and fostering economic growth. The Monetary Policy Committee, MPC, established in 2016, is responsible for setting interest rates and formulating policy decisions. The primary objective of monetary policy is to maintain price stability with an inflation target of 4% plus 2%, while ensuring adequate liquidity to support growth. The RBI employs both quantitative and qualitative tools to achieve these objectives. Among the key quantitative instruments, the repo rate is the most critical, as it determines the rate at which the RBI lends to commercial banks. An increase in the repo rate makes borrowing costlier, reducing liquidity and controlling inflation, whereas a decrease encourages borrowing and stimulates economic activity. Similarly, the reverse repo rate influences how much money banks park with the RBI. Other liquidity control measures include the cash reserve ratio, CRR, and statutory liquidity ratio, SLR, which regulate the portion of deposits banks must keep as reserves. Additionally, open market operations, OMOs, help absorb or inject liquidity through the buying and selling of government securities. The bank rate influences long-term lending, though it is used less frequently than the repo rate. The RBI also uses qualitative instruments like moral suasion, where it persuades banks to follow responsible lending practices, and selective credit control, which restricts lending to speculative sectors. By adjusting margin requirements, the RBI regulates the minimum down payment for loans to control excessive borrowing in volatile sectors. These indirect tools guide credit flow without directly altering money supply. Since the implementation of flexible inflation targeting, FIT, in 2016, the MPC meets bi-monthly to assess macroeconomic conditions, including inflation trends, GDP growth, global financial developments, and exchange rate stability. In recent years, the RBI has been navigating inflationary pressures caused by global supply chain disruptions, raising the repo rate from 4% to 6.5% 2022-2023 to curb inflation. The central bank has also undertaken OMOs to absorb excess post-pandemic liquidity and stabilize the financial system. The impact of RBI's monetary policy is significant across the economy. When rates are raised, inflation is controlled, but economic growth slows due to reduced borrowing and investment. Conversely, when rates are lowered, liquidity increases, stimulating growth but also raising the risk of inflation. The effectiveness of these policies depends on external factors such as global commodity prices, geopolitical risks, and government fiscal policies. In conclusion, the RBI's monetary policy system is a critical balancing act between inflation control and economic growth. By leveraging a mix of interest rate adjustments, liquidity management, and regulatory oversight, the RBI ensures financial stability while supporting India's long-term economic expansion. The Monetary Policy Committee, MPC, plays a pivotal role in data-driven decision-making, ensuring that monetary policy remains responsive to evolving economic conditions. As India continues to integrate with the global economy, a well-calibrated and flexible monetary policy framework will be essential for maintaining stability and fostering sustainable growth.